Hello and welcome again to another edition of 9 to 5 Live. My name is Mark Williams and joining me is Francois Savary. Francois, hello.
Hello.
Nice to see you again. Thank you for joining us. The Federal Reserve cut interest rates yesterday by 0.5%. Some would see that as quite aggressive. Others would see that as welcome and necessary. What are your thoughts on that?
I thought that they took a risk. They took an insurance in a way. It was also interesting yesterday night to hear Mr. Powell, and he said that should he have had the numbers for the employment of July in July, he would have cut by the time. So in a way, they considered that they have the room to act because clearly after Jackson Hole, they said, okay, now it's more balanced. Inflation, we are more confident that inflation is under control. So he said, okay, we have the condition to justify the 50 basis points because we don't want to be behind the curve in terms of monetary policy management. But there is a risk. There is a risk that there is too much complacency about the fact that inflation is under control.
People are already speculating about the next cuts, and in fact, the Fed themselves, in their dot chart, so-called, are showing another 0.5% cut before the end of the year. That is very aggressive. That's a very aggressive new start for a new rate easing cycle, isn't it?
It is. But what is also very interesting is to listen to Mr. Powell after the meeting. Okay, the dots are showing the possibility that you could have a 50 basis points by the end of the year. But he warned also investors yesterday night saying, do not consider that the 50 basis points rate cut is not the new normal for the Fed policy conduct over the coming months. So in a way, he wants to remain in this position to have all the flexibility to do data management assessment. And this is clearly, it is a dovish stance, but it is Mr. Powell tried to refrain people to have too big expectation about another 50 basis point cut coming.
Okay, let's come to the markets now. I can't remember another new rates easing cycle where the stock markets were at all-time highs, and in fact so buoyant as well. So that makes this new easing cycle very, very unusual. How would you describe the current phase of the stock market? Where are we compared to usual historical stock markets?
Okay, clearly what you need to keep in mind is that usually why did the stock market not necessarily perform that well before the first rate cut is because the period you refer to a period in which you could see that there could be a risk of an external shock that was going to produce the recession. And the Fed was reacting to the kind of financial shock or exogenous shock. And that's the reason why we have a different cycle, because currently we don't have any sign that there is a kind of financial risk, huge financial risk that could create an exogenous shock coming. So that's a difference. And this cycle, in a way, is very, very different. Don't forget that one of the thing that we need to keep in mind is that we just come out of the fastest and strongest rate cycle hike in history and for quite a long time. Don't forget that also this cycle was induced by the fact that in 2020, 2022, you had two shocks, the Ukrainian war and the COVID, that have completely modified in a way where we are in terms of financial cycle. When it comes to market, clearly the trend is upward. I think that one of the risks, and people need to keep that in mind, is by cutting by 50 basis points. There is a risk that the Fed is going to nourish this financial quote-unquote mania, and that it could push the market higher and put investors in a position to accumulate more and more risky assets, which could be dangerous down the road. So this is something that we need to keep in mind. And if I had to make a bet, I think that maybe what is going to happen is that people will take a step back and consider, okay, they cut 50 basis points. Don't forget that that there are still economic risk down the road, and you could still have volatility on the market.
All right. Nevertheless, you see this for this. This isn't an inflection point for you. You see this as we can continue the bull market as before.
I think that we can continue the bull market on the equity side if you realize this soft landing. And as I said before, by cutting by 50 basis points yesterday, The big risk is to become too complacent on the inflation front. Because if suddenly inflation shows signs of a revival, then there could be some problem for the equity market, which is absolutely not pricing that. But as long as you have inflation numbers that are coming the right way, which is going to help to produce a soft landing, I see that the bull run on the equity market is not over.
How should we therefore be positioning our portfolio for markets on all-time highs, interest rates starting to be lowered quite aggressively, apparently? How should that change our portfolio, if at all?
I think that we remain in the same kind of framework we mentioned last week, I think, which is be careful with duration. I think that duration on the bond side is no more your friend. The level of interest rate is not very attractive, and I think that you need to be more careful on that. You need to be careful on government debt. It still remains, to my point of view, something that you need to keep in mind. This is something I defend for 18 months, and I still think that you need to be careful. You have more value on the credit side, especially with the Fed deciding that they are going to continue to lower interest rates and entering a cycle of monetary easing. Bond credit can be interesting in your portfolio and a good diversifier in terms of things. You need to be careful with the US dollar, because this is something that there is a lot of question about the US dollar. And I think that the dollar could weaken in the coming quarters, not significantly, but it could weaken. So be careful with the US dollar and do not be too exposed to the US currency. When it comes to equity market, again, I think that you can see over the last few weeks that you have signs of rotation. People are getting into defensive stocks. People are getting into high dividend yield. People are getting more into small and mid cap stock. And by the way, the cut of 50 basis points could be quite supportive for medium to and small cap in the coming quarters. So you need to continue to be diversified on your equity exposure and continue to try to play this rotation that is underway, and that could continue over the coming months.
You mentioned the dollar. Obviously, I was going to come to that. Interestingly, not much happened in the currency markets across most of the major currencies, except possibly the yen. The yen weakened following that announcement. Does that surprise you? Why did it weaken?
It was a little bit surprising, but not completely. You know, the run on the yen has been quite significant since July. It's 15%. The yen is up 15%. This is quite significant in terms of the performance. So there was some reason for some consolidation. I think that you have two elements that can explain why the yen has weakened. The first one is the fact that, as I said, Mr. Powell said, do not consider that 50 basis point cut is the new normal for the conduct of the Fed policy. And the second one is that when you look at the long-term forecast by the Fed, they have once again raised their long-term forecast for what is the neutral interest rates in the US to 2.9% from 2.8. What is important is that over the last few years, this long-term interest rate has moved from 2.5 to 2.9. So in a way, it's telling, and Mr. Powell said it also, do not consider that interest rates are going to grow where they were before the COVID crisis. We are in an environment where medium, long-term interest rates are going to be higher in the US. So it helps support the dollar against the yen, but also against the Swiss francs. The two currencies which were benefiting from the weakness of the US dollar lately, they have been weaker because it tells you that the spread between the US interest rates and the interest rate of those countries are not going to diminish as much as expected, maybe.
You are hinting that you see slight weakness in the dollar, but not by that much. Have I summed that up quite correctly? You see maybe the dollar may be going down slightly, but it's not a one-way bet. Is that true?
For the coming months, yes, because I believe, look at what is happening in Europe, and you still, each global currency has its own problem. When you look at China, clearly China is facing a risk of deflation, very low economic activity compared to what was expected. So not something particularly attractive. the yen can support an appreciation, but not too much of an appreciation. Look at the behavior of the equity market lately. It was connected to the fact that suddenly people realized that this appreciation of the yen was putting a lot of pressure on the economy and on the earning prospect. Look at euro. Euro is still, in a way, in a mess politically. You still have a lot of issue. We had the plan by Mr. Draghi last week. The reception of this plan by some of the members, the big members of the European Union, was quite cold, I would say, the German in particular. So we know that Europe is facing a lot of challenge, and Euro is facing a lot of challenge because it needs to increase its competitiveness, it needs to increase the innovation investment, and etc. and etc. So I see the US dollar, because of the huge accumulation of public debt in the course of the last few years, I see the US dollar under the threat of some weakening, but a limited weakening. I don't see the US dollar, as I said previously, going to 130 cycle, but it could go to 115 and then 120 in the next 12 months. But I don't see more risk on the US dollar in the current environment.
Just very lastly, you mentioned China. Could the fact that the US has entered a new rate easing cycle, could this be a help to the Chinese?
It can help, yes, because as long as you know, at the end of the day, we discussed also that, I think lately, there is one thing. China is benefiting, is suffering currently in terms of economic development, but they are benefiting from the fact that the US economy is still quite strong in terms of economic activity, because look at the way exports are growing, and China is trying to find a way to escape the problem they face through exports. So the fact that the US have decreased interest rates with the idea that it's going to support the soft landing of the US economy, it's a support for the Chinese economy, because it means that one of the major markets for export is going to remain alive. And then, all things being equal, it depends at the end of the day what is going to happen in the US in November. But nevertheless, we all know that both the Democrats and Republicans are in a position which support protectionist measures against China. So yes, it can help, but to a limited extent.
Francois, that's lovely. Thanks very much for sharing your thoughts with us, and I look forward to speaking to you next week.
Thank you, and see you next week. Bye-bye.
Bye-bye.